All right, that's a bunch of trading strategies for you to work with, and a market that's at the moment long and sitting long. 7650 scaled and holding for the first 15 minutes of trade above that mark. We'll renegotiate the markets in a bit. Now let's turn to wider strategies and to our corporate radar segment. We have a big one, a big man from the corporate space. Rahul Khosla, chairman of Max Life Insurance, has joined us. Mr. Khosla, first we'll tell you the good news and why we thought of inviting you. Deutsche Bank came up with an upgrade for your stock, suggesting that is the best listed proxy for life insurance companies. So can we get some comment on that from you?
Well, I think they're right. I think the report captures it well, that this is pretty much it's a solid company with a solid fundamental strength, and obviously they've quoted it right, that this is the very best stock to buy if you want a pure play for life insurance. Let me tell you, we certainly obviously agree, which is that the fundamentals of the company are very strong, whether you look at growth in the value of new business, or you look at the growth in or the return on embedded value, or you look at the net business margins, the new business margins that we have. All of those are.
Yeah, Mr. Khosla, just have to hold on to that thought for a bit. We are getting pictures of Prime Minister Narendra Modi arriving at Brussels.
Listens very closely. But Mr. Khosla, let me come back to you. I'm just taking on another point. Can you tell us whether the group restructuring is over right now or not?
Okay, so the fundamental restructuring that was announced is clear, and it's in the public domain. What is now left to do is that the resulting two companies, which is the new Max India and the new Max Ventures and Industries Limited, those two companies will list, are yet to list, and we're expecting all of our approvals, including FIPB approvals and all of the listing formalities to be completed, hopefully by early May or mid-May, and therefore we expect our listing to be done around then. So that's the last set of steps to be taken to complete the demerger process.
Okay, Mr. Khosla, to come back to your insurance business, your company's market share actually came down because of some very strong growth by the competition. How do you see the market shares going ahead?
Yeah. So my answer to that question is that, look, as a board and as a company, we focus very much on making sure that our product portfolio reflects our strategy of selling long-term savings and protection. So what we don't do, unlike several other private players, we don't chase market share or growth based on the on the state of the equity markets necessarily. So you'll see several players whose percentage share of portfolio of unit-linked products varies very widely. And in FY16, if you recall, in the early part of FY16, there was quite a upsurge in the markets, and therefore unit-linked products became far more popular, and several of our competitors were selling substantially unit-linked products, which we did not do. So our share, and I would argue that our share will continue to be around the double-digit mark, as it has always been, but it will be composed of the right mix of products, which, like I said, is focused on traditional products. About approximately 70% of our products sold are traditional products.
Okay. Mr. Khosla, what's been the trend of premium growth in the fourth quarter, and therefore what are your expectations for FY17?
So our guidance has been that, look, we will grow our book in the high teens, somewhere around there, between 15 and 18%. We're comfortable making that sort of number, but like I said before, and I'm repeating myself, it will be on the back of a very clear preference, continued preference for selling traditional products. And like I said, even for our growth of value of new business, we expect it to grow between 18 and 20%, and we expect margins to hold at around 20% as well.
Okay. Mr. Khosla, will you be able to sustain the new business margins over 20% over the next 1 or 2 years?
Yeah, for sure. Because again, our focus is very much, like I said, on both the non-par chassis as well as protection products. So for us, that's where we believe that we will focus on, and therefore we certainly expect to hold up the margins that we've got so far, which is around the 20% mark here.
Okay, that's good to hear. And just one final question, if you could help us with the cash and the debt levels on all the three group entities.
We have zero debt in any of the three holding companies. So we are a debt-free holding listed company. That's a very big point. The cash has been distributed approximately 100 crores in the first company, which is Max Financial Services, approximately 350, 400 crores in the new Max India, and a very small amount of 10-15 crores because we really don't need the cash in Max Ventures at the moment. So that's sort of the division of cash that we've done so far. As I said earlier, it's a debt-free holding company in all three cases. So again, it's rare to find holding companies with zero debt, adequate cash, and terrific quality assets on the underlying subsidiary company. So good luck to your holdings.
Taken, but what about the valuation of the health arm?
Sure. So I certainly join you in your sentiment that everybody would like to own Max India. I would argue that everybody should like to own all three holding companies because I think there are different opportunities in all of them. As I've mentioned to you, Max Financial Services is a very strong pure play. Yes, I think the new Max India will have health and allied services, and as you know, there's a lot of interest in this sector that we play in, and quite frankly, I think we're very well positioned here. To your question on valuation, look, time will tell. All we know is that we've done some seminal transactions already on the healthcare side, which you're very well aware of, which were quite salutary in terms of the sorts of valuations that we could command. Again, the valuations for good quality healthcare providers and in that space have just recently been demonstrated through the IPOs that have just happened, both at a provider level as well as at a diagnostic level. So I have no doubt that this is a really solid asset waiting to be exposed, and this is a great opportunity because in the past, with a consolidated conglomerate, Max India, the ability to shine the light on a great asset like Max Healthcare, for example, was somewhat obscured. Now, with the new listing that we're expecting, this will really be a very big focus for investors as well. So we're very confident of the growth. The last thing I'd say on that is that, particularly on the healthcare side, we have invested significantly in two acquisitions that you're aware of, one in East Delhi and one in Saket. And frankly, those give us an outstanding headroom for growth, both in terms of capacity, occupancy, and profitability. So this is an asset to watch, and I would join you in your sentiment to saying we should own more of it.
Well, actually, we wanted a valuation idea, but we'll leave it at that. I can understand your not wanting to commit yourself. Thank you very much, Mr. Khosla, for joining us with some details on the life insurance business. Okay, let's quickly get to the markets just to tell you that the markets have just given up that 7650 mark. Not a whole lot, but remember, Anuj kept warning you that the persistent weakness in H